Hello and welcome. Good afternoon, everyone. Thank you for joining us for today's live webinar. Today we'll be tackling corporate tax in the UAE. We'll be addressing deadlines, deductions, and common mistakes. My name is Cheyenne Carvalho, and I'll be your host for today's session. Before we begin, can I please have you drop a comment as to where you're joining in from today? We have some Dubai people. We'll just give a few more seconds for people to join and let us know where they're calling in from. Okay, so we're here to unpack some of the most pressing questions businesses are facing when it comes to corporate tax compliance in the UAE. You'll be hearing from our experts today who work on this every single day, helping businesses structure smartly, file correctly, and avoid costly errors. So here's what we'll be covering in the next hour. What UAE corporate tax means in practice, threshold exemptions and free zone relief. We'll be understanding what qualifies as taxable income and who needs to file. Then we'll talk about how to align your business activity and structure with tax compliance, what documents to prepare ahead of key deadlines, and finally, we'll be exploring some real world examples of what goes wrong and how you can avoid it. So before we dive in, let me briefly introduce to the leadership behind today's session. At Dawia Family Office, operations are led by Anisa Bulahia. She's a strategic advisor committed to bridging Africa and the UAE. With a background in banking and entrepreneurship, she brings a value-driven approach to helping African businesses scale internationally. She's also known for her business engineering focus, guiding families and investors through complex cross-border structures and transactions. Welcome, Anisa. We're also joined by Sagar Shah, Mistry, a UAE corporate tax advisor who has supported dozens of companies through their first tax year. Sagar brings a deep, in-depth knowledge of free zone incentives and tax structuring and planning. Whether you're running an operational business or managing an investment platform, he is the guy for you. So as we begin, over to you, Anisa, to kickstart our session.
Thank you, Cheyenne, for the introduction. Welcome, Sagar, and welcome to our entrepreneurs who are listening to us today. We will jump straight to the start, Sagar. And it's not a secret for anyone anymore. The UAE, after the VAT, which was implemented in 2018, if I remember well, has now implemented the scary corporate tax. Everybody's talking about it. It's for legal and natural persons, if I understand well. I would like you to tell us a little bit about what is corporate tax in a nutshell.
Okay. Once again, good afternoon, everyone. It is nice to join everyone in this wonderful afternoon. So, corporate tax in a nutshell is that any company is making profits, they have to pay corporate tax on the same. This includes mainland companies, unqualified free zone companies, your offshore entities, as well as your national persons taxation. There are a few reliefs also in relation to various kind of small businesses, which we can discuss as and when we proceed on further during our webinar. However, till 375,000 dirhams, there is 0% corporate tax on your profits. And as soon as your profit increase more than 375,000 dirhams, or basically $100,000, you have to pay 9% corporate tax on your remaining profits.
Thank you for the introduction, Sagar. You mentioned some specific cases. We can hint that it's related to the authorities and the jurisdictions and the type of activities you have in the UAE. Can you please let us know what are what free zone stands for in the UAE. Can you explain the difference between a fenced and non-fenced free zone, and what's the impact on customs and on corporate taxes? And then for the non-fenced free zones, can you please tell us a little bit more about how we could qualify for the exemption?
Yeah, sure. That's a great question, Anisa. So UAE has more than 40 free zones. Okay, each offer their own streamlined company setup, and everyone has their own advantages. Someone is linked to the sea, someone is linked to the air, someone is a service-based free zone. So a free zone is a structure in which all the government services are provided under one roof, and the company does not have to run to different departments. Now there are basically two kind of free zones. One is fenced free zone. So fenced free zones are those which are basically fenced by custom boundaries and custom borders. So any entry and exit of goods, vehicles, or individuals are monitored by the authority. These are basically fenced free zones, and normally these free zones are for manufacturing and trading of goods. Then we have non-fenced free zones, which are basically kind of service free zones in which there will not be any boundaries at each of the entry or exit areas. However, they will be marked as a free zone by the authority, and the businesses operating there will have their free zone structure. So that's the difference between free zone and non-free zone. Corporate tax benefits can be made available to fenced free zone entities as well as non-fenced free zone entities, depending upon what business activities do you have, and basis that qualification the exemption can be availed for corporate tax.
Um, Thank you, Sagar. If we can go to the next slide, Cheyenne, please. Yes. Thank you, Cheyenne. So, Sagar, you explained that there are some free zones that are fenced, non-fenced, qualifying, non-qualifying, etc., designated, non-designated. Amongst all these free zones we are seeing on the screen, can you please tell us which ones are designated free zones?
Okay, so when you say designated free zones, there is a complete list provided by the authority. So Jebel Ali free zone is a designated free zone. Dubai Airport free zone is a designated free zone. Let me give you a real example what differentiates and what kind of business activities you can do between two different free zones. Let's say you're looking in a fenced free zone. You're located in a fenced free zone, which is a Jebel Ali free zone. That's ideal for your business if you're going to do trading of goods and you use sea transport as your official mode of transportation. So then Jebel Ali Free Zone is the best free zone for your business in which you can have a license over there, have office over there, and obviously take corporate tax benefits in that free zone. However, let's say if your business is into a holding company business, whereby you want to open up your holding company, then you have option to open up in any of these free zones, provided you fulfill the substance requirements of the authority, and that way you can utilize the free zones benefit in whichever jurisdiction you are.
Thank you so much, Sagar. Now we understand what corporate tax stands for. I still hear many entrepreneurs telling me, but it doesn't apply to me. Or, yes, I have done the registration. I understand the registration is mandatory for me, but I'm not eligible for the reporting or the filing. Uh, can you please clarify who must file to start with?
Yeah, sure. So each and every entity that is registered in UAE, each and every company that is registered in UAE, they have to first register with in corporate tax with MRA tax authorities, which is the federal tax authority of UAE, and then they also have to file the tax returns with the tax authority on time to time basis, depending upon which financial year do they follow. Whether it is UAE resident company, it's a foreign branch entity, free zone entities also have to do it. And also if there any natural person or individual or sole establishment conducting business in UAE, and if that business is more than 1 million dirham, then even they have to get registered and file the corporate tax returns. So in a nutshell, everyone has to do the compliance. There is no exception from that.
Exactly. And can you tell us a bit about what's a taxable income in the UAE under the UAE legislation?
So UAE has kept it fairly straightforward when it comes to calculating your taxable income. Whatever your business profits are arrived in UAE, that is counted as a taxable income. If you have any capital gains from in your business, that is also counted as a taxable income. If you have any revenues from investment income, that is also counted as a taxable income. Okay. So basically, in a nutshell, all the gross revenue of the company needs to be identified and assessed, and that falls under your taxable income after certain exclusions and deductions, which we will discuss later.
Sure. And Sagar, what is the filing process in the UAE?
Okay, so filing process in UAE is ideally as soon as your financial year ends, you have 9 months time to finalize your books of accounts and file your tax returns. As soon as you file your tax returns, you are supposed to pay your taxes also. Currently, there is no advanced tax provisions or withholding tax provisions in the UAE, but it's advisable for companies to have that kind of mechanism in place whereby they are every quarter they are verifying their books and doing a provision for the taxes from a cash flow perspective.
Thank you so much, Sagar, for this summary. I was saying that often we find ourselves firefighting because a lot of entrepreneurs that come to see us for the first time, they already have a fine or they're totally lost on what they need to be doing. How can we help entrepreneurs set up properly or restructure quickly enough to avoid the threat of a fine over their head?
Yeah. So see, the best practice for a company is always to an assessment to see where do they stand and what they need to do. Few of the practices as outlined on the screen is first and foremost is the business activity considerations. That whatever activity you have on your trade license, you have to make sure that the same activity business also is being conducted from the license. It's not like that there is an activity of uh, let's say trading of goods in the business and the company is ultimately doing holding investments. So that's not advisable structure and it can create problems from the authorities perspective as well as from compliance perspective. Okay. Company should.
Sagar, on this point, I understand now why the FTA came to us stating that we need not only to declare the activity in the FTA portal in the Emirates tax, but also to put the activities by order of execution, let's say, or of activity. So the most important one as primary, etc. So that's linked to the fact that the type of activity we're doing is actually impacting the taxes very directly, right?
Yeah, that's actually a very good and up to the point, Anisa, because the thing is, recently, as you said, the authorities updated their activity list to map with the trade licensing in the UAE. Before the activities were there, but it was not 100% in correlation with the trade licensing department. Now that loophole has been covered basically, and now the activities, 90% of the activities that you find on your trade license will be there on the tax authorities portal, so that there can be a proper alignment between tax authority and licensing department.
Thank you, Sagar. We can continue.
Yeah. The okay, so we already covered business activity. The second is optimal corporate structure. Once an assessment is done, company will be able to identify that whether they need to be situated in mainland or in a fenced free zone or in a non-fenced free zone. For example, let's say if a company is into holding company business, then they can go to either fenced or non-fenced free zone, set up their substance over there, and take the benefit of corporate tax exemption once they fulfill all the requisite conditions. So this can also be done in order to make sure that they make the most out of UAE tax laws. And the third is substance requirement. If they are situated in free zone, they have to make sure they meet the substance. Means they have an office, they have employees working over there. Management decisions have been taken from the company itself, so that this all thing needs to be practiced in real life when operating your business over here, so that companies don't incur any kind of fines or penalties or any regulatory issues in the future.
Yeah. And Sagar, if I may add at this point, because that's what we do for our client, we help them set themselves up in a way that they exercise their business, or they execute their business in accordance and in compliance with the laws and regulations of this country, including the tax regulations, of course. And one option there on your third point, one option is the outsourcing. So in our case, a lot of our clients have an LOE with us, a letter of engagement with us, whereby they outsource to us a certain number of businesses. And also they register their office with us because we have a business center, a multi business center. So all of this will allow them to actually justify substance the day they have to justify the substance vis-a-vis the government and the tax authorities, right?
Correct, correct. So obviously, the substance is identified on a case-to-case basis, but yes, having the office, the infrastructure, the support of the employees, that always works in favor of having a substance in the UAE.
Yes, absolutely. And also managing the company, directing and managing the company from the UAE. And on that point, we also offer a non-executive directorship and secretarial role. So we help our client help hold their quarterly board meetings in the UAE and document all that governance process as well, so that the day they have to report to the tax authorities, or the day they are under an audit by the tax authorities, they can justify all these steps that are required to prove the substance in the UAE.
That's actually a very good practice, Anisa, because documentation will help the companies a very in long run. It will help them a lot, so that whenever the authorities come knocking at their door, they always have this support and the documentation, which will help them.
Absolutely. Absolutely. Super. Thank you so much. In order to be tax compliant, can you please tell us what are the boxes any entrepreneur should tick, like a kind of a checklist that an entrepreneur should have on his desk in his office to make sure that he's always tax compliant?
Yeah, sure. So first and most important document is your books of accounts. Once the books of accounts are completed, it needs to be audited by an external auditor. So the audit is mandatory in mainland if the companies have more than 50 million turnover, or for free zone if the free zone entity wants to claim exemption. However, it's always advisable to have the audits, because a third party certification and independent auditor certification uh, helps the company in long way, in terms of investments, in terms of their compliances, and in many other factors. The second important document is your transfer pricing documentation, which comes in terms of your transfer pricing study reports, related party agreements on case to case basis, transaction to transaction basis, again, which will help you during your tax assessments and audits. And the most important is the supporting evidence in terms of claiming exemption. When you want to claim exemption, you need to show whether you have registered office or not, whether you have employees or not. All the functions in terms of office, renting an office or buying an office, hiring employees, they're all linked with government authorities. So authorities can easily identify whether this substance was there or not there. Okay, so this is in terms of documentation. Now, when we come to the disclosure obligation, now as soon as the year gets completed, company has to file the tax returns. So in that, the first and foremost requirement is the related party transaction. Any transaction done with group companies or companies in which the shareholder has influence or the related party has influence. Then your foreign sourced income. If UAE company has a branch, let's say there is a UAE entity and there is a branch in Angola, then that Angolan entity's profits and source of revenue and income also needs to be disclosed in UAE corporate tax returns. The next is tax credit. There is a chance that the branch has already paid taxes in the local country's jurisdiction. So the proof of that tax payments, the tax returns filed, tax payment challan, double tax avoidance agreements, TRCs, tax residency certificates, all these documents help the entity to secure a tax credit in UAE for any taxes paid outside UAE. And obviously, the most important is the salary benchmarking of managing directors who are also shareholders. So any salary which is paid to the shareholders and it is more than half a million dirhams in a year, they need to disclose and do an independent salary benchmarking, that whether the salaries are justified or not. And the same we have to upload in the tax authorities portal also when we file the tax returns. So
Yeah.
all this needs to be taken care of.
Yes, Sagar, I would like to insist on the third point you just mentioned. It's very, very important because in a lot of the cases we see our client are in the beginning solo entrepreneurs or founders, meaning that they're doing all and everything in their business, and they're the business development, they're the sales, they're the head of operations, they're the execution manager, etc. So they're doing everything on their own, and they're kind of like, yeah, one man show in their business, and they deserve and are entitled to a salary, of course. However, we need to justify it because it could appear like an evasion of taxes if we don't do things very, very properly. And half a million a year is like what, 40 to 45K a month, which for a UAE manager based in Dubai at least is a salary that is quite easy to achieve, right? So
Mhm.
we absolutely need to document all of these steps so
Yes,
that if there is an audit, and not just if there is an audit, actually we have to declare that
correct.
on the portal and attach the justification. So in any case, we have to do it. And that's very important point. I allow myself to insist on it because most of our clients are actually in this situation.
Ah, okay. Understood. Understood.
Thank you so much. Thank you. So, the next point, Sagar, while everybody is spending time tanning on the beach, can you please tell us why our client or the people listening to us today should actually employ this period of the year, or the next few weeks, I would say, few days, few weeks, to do a tax health check? Why is it so important that they do this work and that they do it now?
Ah, okay. So first and foremost thing that what whom all the business owners and the top position personas whom I know, they are always working whether they are on holidays or they are not on holidays. So considering that, so right now it's a very strategic time because summers is kind of a slow season in UAE. So it gives the management an ideal time to do their assessments to see where do they stand and to make necessary planning and provisions if there is required, it is required for future. Second, they can also see at what level the document readiness they have, because the thing is to make the documents in terms of salary benchmarking, transfer pricing reports, or any other kind of agreements, it will take time. It's not like it can be done overnight. There is a lot of back and forth which happens in that, and it takes time. And it's an ideal time because let's say if the entity is closing their books on December, they have to file the return by September. So right now also they have almost 2+ month time to do the review and take necessary action. Also, it's a good exercise to do mid review from Jan to June in order to understand if they are eligible for any kind of exemptions, and if they are not having proper licenses, what further decisions or structures can be made to optimize those tax benefits. And obviously, most important is the cash flow perspective. Suddenly, let's say at the end of September, the authority, the management gets to know that there is a 2 million dirham tax which is to be paid, and now there is no time available for that because the deadline is passing by. So the cash flow management also plays a very crucial role. That's why we advise that every quarter it's better to check your books of accounts and provision if there is any tax that is required to be paid, so that at the end of the year there will not be any kind of surprises to your cash flows.
So that's a very good point, actually, Sagar. The last point, we all know as founders and entrepreneurs, we all know that cash is king. And if I understand well, the deadline of September is not just the deadline for reporting; it's actually the deadline for paying as well. And if it's not planned properly ahead of time, it might be an issue. And I recently read a very nice book called Profit First, and it does actually explain that you should have different bank accounts, and you should, on a monthly basis, provision the amounts you will need for taxes, actually. The
Mhm.
book was written in the context of the US, where they pay a lot of taxes, so they need to be even more careful than us. However,
Right.
for us, it's a new exercise as well, and a lot of people are not really understanding the impact the taxes will have on the business. So it's a very good advice to start by provisioning whatever amount you can to face the payment that will be due by end of September 2025. And as you said, like as soon as the 1st of October, the fines will be automatically distributed by the system. So you can be 100% sure that if you haven't done things on time, on the 1st of October, you will wake up with a fine in your email.
Exactly. No, that's a very good point that you covered up because the authority systems are totally automated. As soon as you miss out on a compliance, straight away the fine notice will be issued to you, and in majority of the cases, these fines cannot be waived or reduced in any given circumstances.
Absolutely. So, Sagar, thank you so much for everything you've covered so far. And I think we have learned a lot. Actually, I even I'm dealing with it on a daily basis, but still, I have learned a very valuable information today. I would like you to take us, if possible, through very real life scenarios or very specific examples, so that people can visualize the impact of taxes on their businesses. So, if we can start with the exempt income as an
Sure.
example.
Yeah, sure. So, in the given example, if you see, the company has achieved an accounting profit of 8 million dirhams. Okay. Now, out of this 8 million dirhams, the company has also earned a dividend from another UAE local entity of almost 700,000 dirhams. Now, this dividends from UAE other local entity, which is obviously a tax paying entity. So, again, the company is not required to pay double tax on the same profits. So when we calculate the corporate tax, we will calculate the corporate tax from the profit reducing the dividends. So from 8,700,000 will be reduced, and on 7.3 million, the company will calculate corporate tax, on which first 375,000 zero tax, and on the remaining amount straight away 9% corporate tax. So that's the
Sure.
example.
So, can I ask a question? What if this FLLC entity is actually not paying any taxes? Let's suppose this F entity falls under small business relief, for example, and it's
Hmm.
not paying any taxes. Even in that case, the dividends are exempt.
Yeah. So the thing is, till the time the entity is having a separate substance, in the particular case, there is a separate substance. Let's say the entity falls under small business relief. Okay. So under small business relief, up till 3 million worth of turnover or gross sales or receipts, you don't have to pay any corporate tax whatsoever. Maybe the profit. The profit may be 100,000 dirhams or 1 million dirham, whatsoever it may be. You get that small business relief blanket exemption, that if your turnover does not cross 3 million, you are eligible to take this benefit and don't pay any taxes. So it's a tax complied profit, you can say, in which the tax returns are filed showing the sales and the profits, and therefore even if the dividends are paid, you can still get the benefit because that amount
Right.
is
Thank you.
already complied.
Okay, thank you so much. We can move to another real life scenario regarding covering, sorry, the qualifying free zone.
Yeah, sure. So the example, as you can see on the screen, is about a property which was actually being sold in a Jabal Ali free zone. So an entity was having its location in qualifying free zone. They hold the complete building, okay, and they decided to sell off the building because of some different business acquisition plans. So the commercial property was sold within the free zone to another free zone entity, who then procured the entity, did the valuation, and bought the property. So this falls under a qualifying income category. And basis this transaction, as it falls under the qualifying list of activities, they can claim qualified business corporate tax exemption. So as such, whatever profits they made on the sale of property, they won't have to pay any taxes.
Okay, so it's hard for me to understand all these cases, but I can just learn that every case is specific. So we need to talk to Sagar before we do anything. Sagar, you had given me also an example of Javza as a fenced free zones, a company that would have a flexi desk and that would be outsourcing everything to the Indian entity without substance, etc. Can you take us through that
Yeah.
example again for the audience?
Yes. Correct, correct. So that was actually a real life scenario which we did, in which the company is located in Jabal Ali Free Zone. On UAE payroll, they have two employees to whom they are paying salaries. However, none of the employees sit in the office in Free Zone because they just have a flexi desk. And all the operations are taken care by the back office team, or you can say in this case the front office team, sitting back in Angola. So in that case, the sales, marketing, distribution, logistics, operation, all the heads, including the shareholders and board of directors, they are sitting in Angola, and all the major business decisions are also being taken from Angola. The turnover of the company is more than $100 million. But when it comes to substance, the company does not have enough adequate substance in UAE, which creates a problem for them. And therefore, although they are in free zone, but unfortunately, they are not able to claim the corporate tax exemption.
Exactly. And in this example, it's too late for this year, but if they would come to you and to HKMS, you would advise them to restructure for the upcoming years so that they can optimize
Correct.
their structure, enhance their tax structure, and pay potentially less taxes. So it's like a business decision, right? You have to see the
Yeah,
savings
yeah.
versus
It's correct. It's
the
always
tax you
better
have to
late than
pay.
never. Correct. It's always better late than never, at least to take that decision, get that assessment and optimization done, and then accordingly make a decision.
Yeah, and if I remember well, your advice here is not to claim the exemption for the first year because if you do, you may not be eligible and then it will impact you for the next 4 years. So it's better to go for a straightforward
Exactly.
declaration or filing and then set yourself up properly to claim the exemption later.
Exactly. And authorities can easily identify and verify whether the substance was there or not by looking at their travel records, by looking at the office size, by looking at how frequently the employees are traveling to the office. So it's very, very much evident when authorities will come and audit during those 7 years, because that's the time frame, 7 years they can come and audit. And if they found it out, obviously the company has to pay the taxes and fines.
Yeah, exactly. So let's go to another real life scenario, please. Yeah, capital versus revenue expenditure.
Yeah. So a lot of people think that they are incurring a lot of expense on the capital OPEX, that they are setting up their buildings, they are setting up their plans, and the company will get all this benefit in terms of corporate tax expenses, which will ultimately lead to losses. Is not correct, because capital expenditure is not like you can get it immediately. There is a time frame allowed in that, and basis that time frame, the company has to claim the capital expenditure. Okay, because in a particular year you can only claim revenue expenditure. So let me just give you a random example. Let's say a company has bought a motor car for the personal as well as work use of the staff. So at the end of the day, the staff takes it to their home. So in this particular case, this asset is in capital nature and the company is not eligible to claim the expenses for the same. However, if there is any petrol charge, insurance, repair, maintenance, they can claim that because that's a revenue expenditure. Okay. However, let's say if there is an entity who are into buying and selling of cars, then the car becomes an inventory. And as and when they sell the car, they can claim the benefit of that purchase made. So that's the benefit. So that's the differentiation between capital and revenue expenditure, and it needs to be checked on case to case basis. What will be eligible and what will not be eligible.
Thank you so much. And one example that we're always fighting back and forth with our clients on the entertainment expenditure because I think in different European countries the rules that apply are very different. The UAE came up with a weird way of classifying the entertainment expenditures. Can you please give us a real life scenario?
So it's very simple. The way they have, obviously it's different definition of entertainment for different entities and different set of personnel, but the authorities have clarified it very well that okay, if any expenses which are of entertainment nature and for personal purposes, then it is not eligible for any deduction or any kind of reduction from your taxable income. However, the entertainment expenditure is for business purposes. Then 50% of whatever money that you have spent, you can claim that back as a deductible expense. So if you see at the particular example that a company owned stadium box is used only to entertain clients, which is a valid business purpose. So 50% of the cost is deductible as entertainment expenditure, but remaining 50% is non-deductible. Now, let's say this company owns stadium is not used to entertain clients, but used for only family members. Then this becomes a personal entertainment expenditure, and as such, none of the amount of the deduction for entertainment will be eligible. Okay, so there is one other example also. If you see on the screen that there is an entity called R who is a manufacturer of IT equipments who was celebrating a new event for their new factory, so, and in which they have spent almost 300,000 dirhams and which they state as entertainment expenses. Again, it's purely for business purposes because you have opened up a new factory, so there needs to be a grand inauguration. So 50% of such expenses are deductible, but the remaining expenses will be added back to your net profits. So let's say in this current case, the company had a profit of 7 million dirhams, 150,000 of the unallowed, or you can say disallowed expenses will be added back to your income or profits, and you'll have to pay taxes on the same.
Absolutely. So let's go now to an example where you will compute the numbers for everybody to have a better understanding of everything you've taught them so far.
Okay. Okay. So I don't know if the audience will be able to see the slide. So I will just try to explain one by one numbers for the easy reference. So consider in this given case, this is an actual life scenario which we have recently done last month for one of the companies. The company had a profit of approx 10 million dirhams. Okay, profit. So this includes all kind of exempt incomes also. This excludes all kind of deductions, whether it is non disallowed deductions, allowed deductions, whatsoever it is. The company's net profit, the financial statements net profit was showing 10 million dirhams profit. Now, in that, the company had dividends from other UAE companies, which is close to 1.5 million dirhams. Now, that is treated as an exempt income, so that was reduced from the tax computation. They also had dividends from foreign companies, in which they had 10% shareholding. Now, foreign companies' revenues are also allowed to be claimed as a deduction, provided the companies have paid taxes in that foreign country and it is at least 9% or more than 9%, which is the UAE corporate tax. So that condition is also being fulfilled. They were paying 25% taxes back in the country in which they had the branch. So that income, that's why that dividend is also being reduced from the computation. Then there is entertainment expenditure, which was for business purposes only. They opened up a different sales outlet. They met the targets, and for that they had a celebration in the office for which they spent 2 million, but out of that 1 million was only allowed as a deductible expense. The rest was added back. So that's why if you see in the proposed example, it's added back. Personal expenses of the shareholders in terms of the travels and everything were also included, which we again removed and added back to the income. The company had a small fine and penalty for some non-compliances done in the past. Fines and penalties can also not be claimed, and it is a disallowed expense. So that's why it is added back to the accounting profits. And remuneration. So company was taking managerial remuneration, but they did not do the benchmarking. When they did the benchmarking, they got to know that although they have taken a salary of 1 million dirham, but as per the salary benchmarking, it's only half a million dirhams. So remaining half a million dirhams that was added back to the business. After that, previous year's bad debts of 2023 that were also added back because it did not meet the transitional provisions rule. Donations were also made, but they were not made to a qualifying public benefit entity. Authority has provided a list of qualifying public benefit entity in which you make donation, you are eligible. But the current donation was outside the scope of those qualifying public benefit entity. So that's why again it was added back. Finally, after doing all the deductions and additions, the net taxable income, if you see, it comes close to 8.6 million dirhams. So initial 375,000 is reduced from the tax computation purpose, and remaining 8.3 million dirhams is considered as a taxable income for the purpose of 9% corporate tax, on which the company actually paid 748,000 and 350 dirhams. So it's not a very easy calculation as such. Each and every item needs to be identified, analyzed, checked, and verified to make sure that the companies don't have any kind of problems in the future when the audit or assessment comes in the company.
Exactly. And every line has the supporting document addressed to the company, and your proper like tax invoices, etc., etc. So it's not just a matter of doing the numbers, but it's a matter of ensuring that every supporting document is there. Sagar, my apologies before that I missed one point, which is the small business relief, and it's a very important point. So if we can go back, Cheyenne, to the small business relief, and if you can explain to us what is small business relief and how it happens in real life.
Okay, so let's say a company, let's say there is a management consulting company or a service company or a brokerage company who is having the base of operations in UAE, and they are conducting their business in UAE. In the current financial year, that is 2024, if the companies does not have turnover that exceeds 3 million dirhams, so in that particular case, they are not eligible to pay any taxes. So I'll give you a real life example. We are working with one of an advisory firm which has a turnover of 2.8 million dirhams, and out of which they had a profit of 1.2 million dirhams. Now, because they fall under the small business relief criteria, they don't have to pay any tax on the 1.2 million dirhams profit, although it's more than 375,000, but still they got this benefit. The simple reason is the turnover is below 3 million and they are being classified as a small business for the purpose of corporate tax. So UAE authorities really want to support smaller businesses by providing them tax benefits as well as less compliance.
Absolutely. Thank you so much for this. Despite like everything we've explained, and I mean, there's a lot of literature out there. There are a lot of people communicating on taxes, etc. But a lot of us are still not very awake, let's say, not aware, but very awake to the situation. Can you please let us know what would be the penalties if we don't comply with what the federal tax authorities have dictated
Okay.
to the businesses in the UAE?
Okay, the first and foremost penalties that we have seen right now is the tax registration delays. You, as soon as you set up your company, you get 3 months time to do your tax registration, corporate tax registration. If you don't do that immediately on the first day or fourth month, you get the fine for the late registration of the taxes. Then also when you deregister your corporate tax, let's say you have closed down an entity and you want to close your tax registration also, so it's not automatic and we have to close it by making a submission to the authorities, in which if any delay happens, the fine start from 1,000 and it gets up to maximum 10,000. So 1,000 per month of delay, it goes on increasing. At the end of 10th month, it gets stuck at 10,000. Then tax returns and payment violation is also there, that if you don't file your tax return. So as I said, let's say your deadline to file the tax return was 31st July because you follow a different financial year. So as on 1st of August, the company receives a fine of 500 dirhams per month for first year, and from second year it will increase to 1,000 dirhams per month. Although these fines are very small, but over a period of time they can get accumulated and can create a lot of problem for the entities. Plus, there is also 14% fine if you don't pay your taxes on time. Plus, if you don't follow the compliances, there is a high chance that the authority can come and inspect your books of accounts or audit your books of accounts also. Again, in audit, if they found any issues, they can put fine for that as well, 20,000. If there are not proper records, they can put fine of 10,000 per violation. And again, in future, if they came and they found out some other issue, they can again put 20,000, because then it becomes a repeat offense. Again, these are all the numbers which are basically kind of a voluntary tax delays. In case if they find that there is some kind of tax evasion which is done by the client directly, then the fines can increase more. Although clients, let's say even if the client done it, but if there is no documentary proof available, it can backfire them.
Absolutely. So, conclusion, these may look small, but they add up quickly, and there can be also more penalties in the case where there is uh, a will to defraud the taxes.
Yes, correct.
Absolutely. Thank you so much, Sagar. I think that takes us to the end of our presentation. Thank you for all the valuable inputs. I will give now the chance Cheyenne to take us to the next steps. Thank you.
Thank you so much, everyone. And again, Awzing, thank you to Anisa and Sagar for such an amazing session. I was saying before we move on to the questions, I was trying to convince Anisa that we get a team massage chair. So maybe this means that we can get one. Anisa?
Will it be deductible if we have a
Will it be deductible, Sagar?
massage?
We make
If
an
it is,
appointment each time.
if it is part of business planning and usage for business purposes, then yes. Will you do meetings after that? That's more important. And
Maybe we should do meetings from the
okay, will your
chair.
work efficiency improve? Then yes.
Okay, thank you so much. So let's open the floor to the questions. If you haven't already, please drop us your question in the chat and we'll take as many of them as we can. So the first question that I have, Sagar, is VAT the same as corporate tax?
No. So VAT has been introduced since 2018. It's a tax on your sales. Whatever sales or services you do locally, you have to pay 5% on that. But as such, they both are different. Corporate tax is tax on your profits, which is both totally different. One is direct tax, one is indirect tax.
Okay, and then we have a question from the chat. How does group tax relief work in the UAE for UAE-based corporate groups with the same UBOs?
Okay, so one of the most challenging issues in multinationals or big groups are the intercompany transaction, intercompany usage of manpower, and intercompany usage of resources, which needs to be allocated on timely basis to each and every company, which every company does not want to do because it creates a lot of hassle in terms of documentation. That's where tax group comes in. If the entity is registered as a tax group, so any transactions that happen between the group companies, there is no transfer pricing compliance needs to be done for the same. So they can do the transactions on cost to cost basis, cost plus their internal markup. But basically, it will be treated as one entity and not different kind of entities, which saves them from the hassles of transfer pricing and other regulatory compliances between the company transactions.
Okay, thank you so much. I don't know if everyone can see Sagar. I have a bit of a screen freeze at the moment, but he is audible. I think it should be fine. Next question we have: how should free zone companies prepare their documentation to prove they meet the qualifying criteria for 0% corporate tax?
Okay. So the first thing is they need to get a corporate tax assessment done in order to identify that whether the activities that they are doing falls under the corporate tax exemption, whether the location of the free zone falls under the corporate tax exemptions, whether they have necessary substance, manpower, board minute meetings on a quarterly basis, then your other documentation to justify that whether the company is eligible to claim exemption or not. So it's like there needs to be an assessment in which we can easily identify whether the requisite parameters are being met or not met. Assessment is the best solution.
Okay, another question we have: are there specific industries within free zones that are more likely to benefit from the 0% tax rate?
Yeah, so the authorities have provided the list of qualifying activities which fall under the corporate tax exemptions: trading of goods, manufacturing of goods, processing of goods, your holding company activities, headquarter service activities, logistics companies, then wealth management activities, and certain other activities. If you do this kind of businesses, then yes, your company can qualify for corporate tax exemptions.
So a next one, and it's a quite a big one. ABC Real Estate LLC has 3 million dirhams in accumulated tax losses over the past 3 years and earned 6 million dirhams profit this year. Are they required to pay 9% corporate tax on the full profit, or can the losses be carried forward?
Okay, so let's split it one by one. I'm assuming that the 3 million loss is in the year 2024, because any losses before that are outside the scope of corporate tax. So let's say if the company had a losses of 3 million dirham in 2023, unfortunately they will not be able to claim it in 2024's profit. But let's see the other scenario. Let's say in 2024, the company had 3 million losses during 2024. Okay, not the previous period, only for 2024. And in 25, they have a profit of 6 million dirhams. So this loss can be adjusted, but up to 75%. Okay, till the time if it is more than 3 million dirhams. So in the particular case, they will be able to adjust their losses and pay taxes on the remaining profits. Okay, so it really depends on case to case basis.
Thank you so much. And if someone wants a more in-depth assessment, we can definitely put you in touch with Sagar and his team. So another question that we have: do I need to register even if I don't owe any taxes?
Yeah. So I'm assuming these are limited liability companies, or these are civil companies, or these are basically free zone companies or establishments. They have to register, okay, irrespective whether they don't have any profits. Even let's say if there is an entity LLC, but there are no transactions. Let's say the company is just open for visa purpose. In that case, also the company has to do the compliance and keep the set of documents required, so that in future if authority comes knocking at that door, so they're not surprised.
Okay, and follow up: when would someone like that need to file the corporate tax return?
Okay, so ideally, as I said, the timeline to file the corporate tax return is 9 months from the end of your respective financial year. Now, a company might be following a financial year of January to December. They might be following from April to March, July to June. Obviously, it needs to be documented in their memorandum first, memorandum and articles. Then only they are normally following the different financial years. And 9 months from the end of that particular financial year, the company has to file that taxes returns and pay the taxes as well. So supposedly December 24 is a financial year which has ended. So September 2025 is the time by which they have to file their corporate tax return and pay their taxes if any taxes are due.
If I may,
Thank you.
Cheyenne, I would like to
Yes,
ask
please.
Sagar a question. Sagar, you
Uh,
must be seeing a lot of different scenarios, and some of them might look very weird, some may be very funny. Can you give us like your favorite scenario you have encountered in the last month, for example?
Yeah, I'll give you one classic example of a single owner entity in which they have a turnover of close to 2 million dirhams, and the single shareholder is taking a salary of 150,000 dirhams a month. Okay, he's the only person working in the company. Now his justification was that he was working in a big corporate, and there the salaries were quite high. But the issue is there is a difference between big corporate and there is a difference between an entity in which there is only one employee. So the salaries in a big corporate where there are multiple hundreds of employees, the turnover is great, they have branches globally, they have different kind of portfolio. So the salaries of that particular entity cannot be justified with the salary of a single owned company in which there are no employees, no office, no substance. Okay. So a salary benchmarking, ideally in this case, is required to be done, in which their particular salaries are computed basis that respective industry, respective turnover, respective location, as well as respected number of man force. Okay. And then only we can tell whether the salary is okay or not. So every company or any shareholder is planning to take salary of more than half a million dirham, it's high time that they need to get their salary benchmarking done so that they don't get any surprises in future.
Or they can argue that they still have the same spouse that is costing them the same amount of money between their corporate life and their entrepreneurial life. What do you think? Would that work with the FTA?
So see, the authorities are not concerned as such with the post-tax items. So they are still saying that, okay, no problem, you pay the 9% taxes on your profit, and on the remaining
And then
dividends, you withdraw the money and
you do
spend for.
whatever you want. Exactly.
Yeah, exactly.
Absolutely. Absolutely. So, on this case that you have given, it's a sole establishment, and the person would have to register and report because they're above 1 million. Question: if I am a natural person, am I
Hmm.
eligible for small business relief, or is it just for the legal entities?
So by default, small business relief is available for all kind of entities, including sole establishments or natural person. So
Okay,
they can
that's
make
good.
use of it.
Okay, so in that case, in any case, he wouldn't have paid anything then because he's on 2 million. He could have claimed the small business relief.
Correct. So on a
Okay.
case-to-case basis, yeah, sometimes companies have losses, so they want to show the losses. So we have a company in which they had a turnover of 1.5 million, but the expense of that company was 1.8 million dirham. They didn't want to claim small
Yeah,
business relief because they would have lost that loss benefit which they can claim in next year. So for them, they
exactly.
find a loss return, carry forward the 300,000 loss, which they will adjust it in future profits.
Yes, absolutely. Uh, that just illustrates the infinite number of scenarios that are out there, and the fact that some of us are a little bit familiar with taxes because we come from a background where taxes have been
Correct.
there forever. However, for most of us, we would better come and approach a professional to look at our specific case and help us report in the best way and help us structure ourselves in the best way possible. Just
Hmm.
one last point that I think we didn't cover, Sagar, and I would like to cover it here. Some people have late registration fees, penalties, sorry,
Hmm.
but I've been seeing like more and more FTA calling these owners and saying, hey, or these managers and saying, hey, please do report your taxes before the 31st of July, which is like this week, and we would waive the penalty for you. Question: is it report and pay by the 31st of July, or just report by the 31st of July?
Report and pay your necessary tax obligations. Both report and
Okay.
pay. Yeah.
So I have a lot of cases where they fall under the small business relief. They still have a fine for late registration because it's true that in the beginning, people had a hard time understanding what was really the deadline applying to them, etc. In that case, I go report, claim the small business relief, so I don't have anything to pay, and the FTA will waive the penalty they have applied to me.
Yeah. So initially, we were when we did the submissions of tax returns, so authorities were taking little bit time to first analyze the return and then waive off the penalty. So it's not an automatic waiver. They will check the case to case scenario of a respective entity, and that basis if the conditions are being satisfied, they will waive off the fines, which will get reflected on the portal.
Perfect. So that's a good news for many small entrepreneurs, and we've been actually reporting and declaring a lot of them on the Emira tax this month to give them a chance to get back, or at least to get this penalty waived.
Correct. So it's high time now. I think so. Yes, as you said, last 1 week is better to align your books. If you have not registered, then also it's good time to do the registration and comply with the returns, because we have seen cases where
Absolutely.
the companies have not registered also.
Yes.
So it's
So
better and
that's why
high
the
time.
webinar is very, very timely, guys. We should have done it like 2 months ago, but 2 months ago people we're not worried enough. But I think now like it's a very timely moment, and people should take this very, very seriously. Entrepreneurs, managers should take this very, very seriously and use this next week to put their books together, finalize their accounting, register if not yet done yet, and report. Thank you so much, Sagar. Cheyenne, back to you.
Thank you, Anisa.
Thank you, everyone, so much. So now I will just move on to our closing. Before we close, I want to share a quick snapshot of how we support entrepreneurs like you across both business and personal dimensions. So at Dawia Family Office, we help solve 5 pain points for African entrepreneurs, but not just African, expanding into the UAE. So today's session was focused on one of those pillars, administration, if you can see on the screen, where we ensure your business is fully compliant and ready with the right registrations, filings, and governments in place. So if you'd like to explore the full suite of services we offer, from entity structuring to regulatory compliance, please feel free to browse our website and reach out to our team directly. So next steps, how can you turn today's insights into action? So number one, you would schedule the consultation with us. If you're serious about your expansion, let's discuss your goals and build your roadmap. Number two, you share your business plan. So our team will offer tailored structuring and compliance solutions. And three, we engage with trusted partners. So whether it's accounting, tax, logistics, and market entry, for example, we can connect you with the right experts. We'll be back next month with a new topic. So if there's anything specific that you'd like us to cover, we'd love to hear from you. If you could just drop us a message on our LinkedIn or a DM. That concludes our session for today. And just once again, a heartfelt thank you to our speakers today and to all of you joining. We look forward to working with you and seeing your businesses thrive. Until next time, stay compliant and stay ready. Thank you, everyone.
Thank you, everyone.
Thank you, Cheyenne.